Bismillah ar-Rahman ar-Rahim. The next topic is depreciation. Depreciation is the decrease in worth of the asset. You buy a car, for example, for about 10,000 Real, and then after 1 year it is just left 8,000 Real. Maybe in 3 years or so, the worth of the asset is only 5,000. So it is the decrease in worth because we are using the asset and its life is finishing, and that is depreciation. Because of the depreciation, it is the decrease in worth of the asset. In cost accounting viewpoint, it's an annual charge against revenues used to repay the original amount of capital borrowed from investors. The accountants, what they do is when they make the income statement, they use depreciation as an expense. It's a charge against the revenues because the asset life has been used to generate the revenues. So it's an expenditure. The basic difference between income statement and cash flow statement is of depreciation. There are other differences as well, but this is one of the basic difference, that depreciation is shown as an expenditure in income statement. It's also called profit and loss account statement. In this statement, depreciation is shown as a charge against revenues. It's an expenditure, whereas in cash flow statement, since there is no cash involved, cash flow statement only deals with the cash, the incoming cash and the outgoing cash. So it is different from the income statement. In expansion planning studies, depreciation is used for calculating the salvage value for equipment that have expected lifetime extending beyond the end of study period. The study period may be 5 years only, and the asset life may be 10 years. So after the finishing of the study period, we give a salvage value because the asset's life is still there. We don't say it is zero now. It has a value. So that value is given as a salvage value in our planning studies. There are 4 commonly used depreciation methods: straight line, sum of the year digits, declining balance, sinking fund. If I may add one more important one is accelerated cost recovery system. Cost recovery system. The sum of the year digits and declining balance methods are those methods which are used for tax purposes, and also this accelerated cost recovery system method. These methods are used for showing that initial year there's a large depreciation and later years it is less. It is used for tax purposes to have less taxes paid initially, but in the later years they have to pay more. Why companies do that? Because of time value of money. We will see one example related to that. Straight line depreciation is a straight line which is equal depreciation each year, and sinking fund depreciation is designed to have depreciation initial year less and later years more. Here is the 4 methods we discussed. Sinking fund depreciation is initial year we have less depreciation, and in the later years we have a lot of depreciation. So this is a sinking fund depreciation. Double declining balance and sum of the year digits are shown. Initial year we have more depreciation, and later years we have less depreciation. For example, here you can see that Initial years we have more depreciation coming, and in later years we have less depreciation. One more thing you can notice is that there is a dotted line shown in double declining balance method. This one is showing the dotted line. Why? Because the formula which is used for double declining balance is not exact. So in the later year, in the last year, we have to adjust and deplete the method, deplete the asset. So this is that's why it's showing a straight line at that. We want to finish the asset, whatever the life is left, we have to show that it is depleted completely. Here is the explanation of these. Sum of the year digits and declining balance methods are designed to increase the cash flow in the early years of investment. They are normally used for tax purposes. We will see one example. In straight line depreciation method, the depreciation charge is each year constant. This is more or less very common, straight line depreciation, and they are shown in balance sheet. For example, the straight line depreciation normally is used. In sinking fund, the depreciation is lowest at the beginning of life and increase with time. The sinking fund method is a technique for depreciating an asset while generating enough money to replace it at the end of its useful life. As depreciation charges are incurred to reflect the asset's falling value, a matching amount of cash is invested. These funds sit in a sinking fund account and generate interest. So eventually the compound interest which is generated over the years and the cash set aside, which is generating the interest also, for each depreciation period should be enough to replace the current asset when it is depleted. That's the idea of sinking fund depreciation. Normally those assets which have their prices are very high, some companies, organizations, they generate a fund and they set aside the some amount according to the depreciation each year and sinking fund depreciation, and then this fund generates also the interest, and eventually the idea is that when the asset life is completed, the current asset life is completed, it is able to replace the fund is able to replace the asset with a new asset. Whatever the method used, however, the sum of all annual depreciation charges over the life of the alternative must equal initial investment in the alternative less the salvage value. Here are the formulas which are used to find out the depreciation. Straight line depreciation, sum of the year digits, double declining balance and sinking fund. DT is the depreciation and AD for each year, and AD is the cumulative depreciation. Here the symbols are representing. N is the useful life of asset in years, T is the number of years of depreciation from time of purchase, and V is the salvage value, and N is the of course the useful life of assets, and I is the initial investment or purchase price. So we will see an example. The company plans to change its depreciation method from straight line to the double declining balance method on a class of assets having a first cost, which is the acquisition cost, of $80,000, an expected life of 6 years, and no salvage value. If the company tax rate is 50%, what is the present worth of the value of this change, assuming 10% interest compounded annually? So we see from here that I is equal to 80,000, the initial price of the asset, expected life N is 6 years. And then we have the salvage value V is equal to 0, and the tax rate is you can say T is about 0.50%, and the present worth of the value of this change is assuming 10%. I is equal to discount rate or interest rate is 10%. So here we see the table which is showing how to calculate the benefit that if we change from straight line to double declining balance method. So in the first column we have years, and in the second column we have straight line method. Third column is double declining balance method showing the depreciation. Delta is the fourth column is showing the delta, which is the difference between double declining depreciation minus a straight line. F is the future value of benefit, we can say. F is equal to 1 minus tax into delta, and then the present worth is calculated. So if you see, for example, the straight line depreciation each year, we have the formula here is equal to, straight line is equal to 1 over n into I minus I minus V. V is equal to 0, and 80,000 divided by 6, we have 13,333. There is one more 3 here. 13,333 by 0.33, and that is the depreciation each year charge against revenue. And this is shown here. All are equal. In the second column, for example, all the depreciations are equal each year. Let's look at the double declining. The double declining, we have this is the formula for double declining, where we have I is the initial investment, N is the number of years of the lifetime, and T is the current year. Each year we have different depreciation. So for example, let's see the calculation of the first year. We use the formula, plug in the values, and we get the depreciation 26,666.7. I have just done another calculation. We have shown this, let's say D5, and D5 is equal to 80,000. Again, I into 2 over n into 6 minus 2 over 6, 5 minus 1. And when we calculate this, we get this value here, 5267.5, which is here. So this is how the calculations are. The last calculation here is, we said that double declining balance method is not exact method. So if we have if we sum up the first 5 years of depreciation, then 80,000 minus all these amount, 2666.67 plus 1778.67 plus 1185, 1.87 plus 7901.25 plus 5267.5 should be equal to this 10,534.05. This is the last year. Whatever the life last year, we just depleted completely, because this is not an exact method. as this is using this formula, it doesn't fully depreciate. Now delta is equal to the difference between double declining minus a straight line, and here is the difference coming, and then the future value or the future benefit is 1 minus tax into delta. So these are the values calculated here. You can see that if we add all these, if we add all this, it should be equal to 0, because initial year the benefit is coming like in positive, and then later year it is coming negative. So if we add up all, it should be 0, because the asset life is depleted, and so there is no actually benefit there. But in both cases, straight line and double declining, the asset life is finished. So if we add up all, it is the delta should be equal to 0, and eventually f is also equal to 0. But if we take into account the time value of money, which is the present worth, using the interest rate mentioned here of 10%, then we find out the present worth using the present worth formula. We have, these are the values coming here. This is the present worth formula. P is equal to f over 1 plus I raised to power t. And then if we add up all, we have, this is the benefit coming, about $2,200, about $2,200 is the benefit if we switch from straight line to double declining balance method. So that's why some organizations, some companies, they, for tax purposes, they show that initial year there's a lot of expenditure is there due to high depreciation, and they show less income or profit. And since the income tax is paid on the income before tax salary, or sorry, income before tax, the tax is paid on that, so that income is shown less because of more expenditures. You see the formula here is profit, sorry, let's use this one. Profit is equal to revenue minus expenses, or profit or income. Since income before tax, let's say, is revenue minus expenses. So when you show that you have less income because you have high expenditures, then you show less income, and then you pay less income tax, but you have more cash, and more cash is there, and you get the eventually more benefit is there, because they can use this cash for doing some other, starting another project or whatever they want to do.